Welcome to the Be Smart podcast with Jared Dillian, how not to be an idiot with your money. Because there was a lot of that going around. So everyone is an optimist these days. Everybody I talk to is an optimist. Things are good. You know, here in Myrtle Beach, we actually have the Optimist Club. I guess the prerequisite for joining the Optimist Club is that you're an optimist. I actually spoke at the Optimist Club. This is when my book came out like 10 years ago. And, yeah, I mean, stocks are at all-time highs, crypto's at all-time highs. Things are good. It's very easy to be an optimist. So I was on Twitter the other day, and there was a guy that said, and I'm quoting him, he said, being a long-term pessimist is an ideal way to go broke. And I don't necessarily disagree with that statement. I mean, if you're just short stocks all the time, like that's not a good strategy. It's not going to work. But the thing that I pointed out to him was this is not the type of thing that you hear in March of 2009 when the S&P 500 is at 666 and it's down 60% from the highs. Back then, pessimism was a strategy, and it does work from time to time. Now, over the last 100 plus years, stocks have gone up with a few big bear markets along the way. But if you had a 100-year time horizon, yeah, you could just stay long and make money, and that's how the theory goes. But you see, we don't have 100-year time horizons as investors. I mean, maybe best case scenario, we have a 50-year time horizon. You start investing when you're 25 and you're done investing when you're 75. Maybe it's even 40 years, you know? So with a 40 or 50-year time horizon, that's what we have to work with. Now, a lot can happen over a 50-year time period, like the financial crisis, which was 13 years ago. In the financial crisis, the stock market was down almost 60% from the highs, 60%. So what does that mean? That means that if you had $100,000 saved up and you had it invested in the S&P 500, in March of 2009, you had $40,000, $60,000, 60% of your money was vaporized, okay? Now, one of the things you have to think about that is how you feel when that happens, okay? How would you feel if that happened today, if the stock market was down 60%, if you lost 60% of your money? Probably wouldn't be a happy camper, okay? And it would affect your decision making. Now, if you were an optimist, if you were one of these people that just said, I'm an optimist all the time. You say, this is just a flesh wound, you buy the dip, things are going to get better. March of 2009, you're like, things are getting better, I'm buying stocks, right? But nobody did that in March of 2009. Nobody thought things were going to get better. They thought things were just going to continue to get worse forever. Very few people can take a drawdown of that magnitude, which is why you just can't be monotonically long all the time. You can't, because your emotions are spot dependent, okay? If stocks sell off, you get sad. If stocks rally, you get happy. When they go down, you panic and sell stuff. When they go up, you get excited and buy stuff. And you chop yourself to bits with your emotions, you know? That's why you have to manage your risk. And when I say you, I don't necessarily mean you as in hedge fund managers. I mean actually you, Mr. Retail Investor. Because you know what you're going to do if stocks are down 60%? You're going to barf and sell everything on the lows. And that is exactly what people did. That's what they did. Now, that seems like a long time ago. It's 13 years ago. People have short memories. And I don't think we're going to get a bear market in the immediate future, but we will get one someday, for sure. We will get a bear market someday. In fact, we're probably going to get a big bear market someday. I just don't know when. Could be next year, could be the year after. Maybe it's not for another 10 years. I don't know. It's going to happen. I'm 47 years old, and we will have another bear market, a big one in my lifetime, or maybe 2 or 3 or 4. And as you get older, the timing of a bear market becomes important, because if you lose half your savings right before you retire, that is not a good thing. And that's why they tell old people to be in bonds. Now, people have these return assumptions about the U.S. stock market. They say, well, it returns 8% a year, 10% a year. Okay, I mean, that's what it's done in the past, but we don't know what it's going to do in the future. And people make these assumptions. They have these return assumptions. They say, well, the stock market's returned 10% a year in the past. Therefore, it's going to return 10% a year in the future. It always does this. Not necessarily. It doesn't have to. I can think of some very good reasons why that won't happen. We could have a war. Maybe the U.S. becomes a communist country, a massive natural disaster. I don't know. I mean, in Europe, stocks have been unch for 15 years. They've returned zero over 15 years. In Japan, they've been negative over the last 30 years. And we could have the discussion about what makes the U.S. market so special. But I mean, if you're just looking at this from a macro standpoint, the valuation of U.S. markets is very high relative to the rest of the world, and that's going to normalize over time. And when valuations get this high, forward returns usually go down. Now, philosophically speaking, I am not an optimist, but I'm also not a pessimist. I'm kind of in between. I think things are getting better in some areas, and I think they're getting worse in others. Technology, for example, is getting relentlessly better at just an incredible pace. Politics is getting relentlessly worse. And we as a country, 20 years ago, we were fiscally conservative and socially liberal. And now we've done a 180. Now we're socially conservative and fiscally liberal. It's all happened in the last 20 years. But now we're talking about these people living in the Metaverse, some virtual reality where everything is perfect and we pay for things with cryptocurrencies. Like I said, in some respects, we're going forward. In other respects, we're going backwards. But all of human progress is a series of 3 steps forward, 2 steps back. Stock market topped in 1929 and didn't reach that level again for 17 years. And there's nothing that says that can't happen again. Probably will happen again. So in the meantime, stocks are going up, and this is all picking up nickels ahead of a steamroller. And they say that you should not try to time the market. And that's true. That's true. Most of the time, you should not try to time the market. But there are 1 or 2 times in your life when you should, when you reach an extreme in valuation. March of 2009, did I buy stocks? No, I was scared shitless. I was scared out of my mind. I thought the world was coming to an end, and it seemed like it would. Price determines sentiment. Everybody can be an optimist right now. It's very cheap. It's very easy to be an optimist. But if we have another bear market like we had in 2008, there will be no optimists left, I assure you of that. So if all of human history is 3 steps forward and 2 steps back, wouldn't it be great to be long the 3 steps forward and short the 2 steps back? Okay, so most people aren't capable of doing this, but if you make very subtle changes in your asset allocation, you lighten up on the highs and buy some stuff on the lows, it can make a big difference in your performance. You want to be bullish when everyone else is bearish and bearish when everyone else is bullish, which is why I'm so annoying on Twitter, because I am doing the opposite of what everyone else is doing. So this guy was a little annoyed that I took issue with his comment, but all I'm saying is it's very easy to be an optimist right now. It takes no effort whatsoever. Now, if he was that bullish in March of 2009, great, hats off to him. That's saying something. So I'm a contrarian, and I was not bullish in March of 2009. I was freaking out. There were no bulls back then, and that's what bear markets do. They destroy capital. They destroy the bulls' capital, the bears' capital. It destroys everyone's capital. And I'm not predicting a bear market, but at least I remember what one feels like. I've been through 2 big ones, one in 2000, one in 2008, plus a couple of smaller ones along the way. Now, for what it's worth, I was bullish in March of 2020 during the pandemic, but it wasn't easy. I bought some stuff, but I did not shove all in. And if you recall, we had a couple of days where the market was down double-digit percentage points. And it takes courage to shoot against a bull market. You have to be insane. Calling a top is much harder than calling a bottom. But there's a general principle here, and this is, as an investor, you must have courage courage and judgment, and it takes judgment to know when it is time to be courageous. And this is not the time to be courageous. This is the time to go with the flow and buy stocks. My goal with the markets is to make a living, to return 10 to 12% a year with minimal volatility. If I do better than that, then that's great. It's a job, it's a career, not a call option. If I make 10 to 12% in the good years and 6 to 8% in the bad years, then that is a lot better than most people are doing. And avoid the blow-ups, don't take too much risk. Optimism does make more sense than pessimism, but it doesn't always work. You have to know when. I'm Jared Dillian. You've been listening to the Be Smart podcast. See you next time.